Hi, this is Kribakaran Rajendran, founder of Algo Trading from squareoff.in. So in this video, we'll be talking about how to backtest correctly. So even though there are multiple platforms, multiple no-code platforms that provides you an option for many beginners to get started with rule-based trading, there are many mistakes that most of the beginners do when they are trying to backtest with specific data. So we'll try to address how to backtest correctly, what are the methods that needs to be followed, and then we'll try to address what are the things that you shouldn't do when you're trying to backtest with no historical data sets. So those are the things we'll be addressing in this video. With respect to backtest, most of the people what they do is, or what they consider is, okay, instead of backtesting for a shorter period of time, there are people who backtest just for 1 month or 1 week or just for 2 or 3 months. That is absolutely bad, which you shouldn't do it. You need at least 3 or 5 years of data to backtest any of your trading ideas. But again, the problem is people think that, okay, if I backtest with 10 years of data, then it could give me a robust results, or I could develop a robust trading strategy. So again, the problem is it is need not that you need to backtest your trading strategies all at once. Like if you have 10 years of data, do not go and backtest with 10 years of data all at once, because when you're trying to do it with all sets of data, there is a chance that you might curve fit your complete data based on the stop losses, based on the targets, whatever that you wanted to fit in. So basically you need to segregate your data into in sample data and out sample data. So this is nothing but, say suppose you have 5 years of data. So in this 5 years of data, what you have to do is you first segregate in sample, which is the first 3 years of data you keep it as in sample, and the last 2 years of data you keep it as out sample, which means that your in sample data should be used to test your logic, to test your trading strategy, and your out sample data, which is the other 2 years which you have kept aside, should be used to validate what you have tested in the in sample. For an example, consider you have created a trading strategy and you wanted to test it. Like you have an idea and you want to test this logic. Say suppose I wanted to buy a stock when it moves above 200-day moving average, and I wanted to sell it when it moves below 200-day moving average. I keep this as a normal constant. Like I go and test it in sample data and see with 5 years of data, I'll just check in the first 3 years how it has performed. Then I'll see, okay, this is how the returns are, this is how the drawdowns are. Then I go and test the same logic in the next 2 years of data and validate it, whether it has given the similar kind of results, whatever the good results that I have seen in the test data, in the in sample data, am I able to see the same results in out sample. So this is how you validate whether this one which you have tested is working fine with the out sample data. This is essentially important because, say for an example, I'll try to give an example on how you shouldn't do this, like how people end up doing curve fitting. I'll try to explain that in example so that it would be much more easier. But the gist of this is, make sure that you don't test your logic all at once with all data together. Instead, segregate that into in sample and out sample and test it. This is because when you have too much of parameters and try to test with all sets of data with 5 years or 10 years of data all at once, there is a high chance that you might end up with curve fitting. So whatever the thing that you have tested might not work when you take it live, when you have too much of parameters. So I'll try to example what it is with ongoing example. I'll take and consider this 920 short straddle strategy. I'll try to explain that with no perfect example how people might end up curve fitting. So when you're trying to backtest, when people say that you need to backtest with large historical data sets, they are primarily meaning that you should backtest your trading strategy across different market cycles. So more than the number of years, it doesn't matter how many number of years you backtest. All it matters is, are you covering the different type of market cycles? For an example, 2008 to 2009 was a complete bearish phase due to global financial crisis. The entire global markets was collapsing. So that was a very high volatile environment with a complete 18 months of bear period. And again, 2012 was a complete flat period. Again, 2016 to 7, during the end of 2016, due to demonetization, due to Brexit, it was again a volatile month. 2017 was a complete smooth, non-volatile year. However, it was a trending period. Again 2020 there was a corona crash period. So all these are the different market cycles, different market regimes that has come into a picture during different phases in the market. So when you try to backtest with larger data sets, all you are implying is it doesn't matter that you wanted to test it out with 100 trades or 1000 trades or 2000 trades. All it matters is, are you able to cover these important market cycles, and you wanted to test whether your system is broken or not during this important market cycles. So that is why most traders emphasize on testing your strategy on different market cycles altogether. Because for an example, if someone who started their trading journey in 2017, consider he is an option seller. So if he has tested, or if he has just started with an option seller during 2017, that would have been much more smoother and easier phase. So by the end of 2017, his confidence would have skyrocketed to a greater level. You would have thought, okay, having an option selling system on this markets is much easier, and I could deploy much more capital because option selling is much easier. But what followed the next year and the other year was completely highly volatile phase. So what we have witnessed in the recent past as a higher recency bias towards us, because of that we tend to believe that is what the market is all about. But only when you zoom out and check out with the different historical periods how the markets behaved, and then when you try to test your logic on those periods, that gives you a greater insight, and that tells you whether your strategy is going to break or not. So these are the three important factors when you're trying to backtest with your historical data. First, you have to segregate your data into three types. First, divide it into two, and keep one part as in sample and keep the other part as out sample. And whatever the logic that we wanted to test, we test it with in sample data. And then say suppose you are initially starting with 200-day moving average, I wanted to test it with this data, and then you go and apply it with out sample and see whether it is working fine or not. Because if when you try to when you see in sample data 200 is not working fine, probably I wanted to use 150 and then see I'm going to get maximum results out of it. So instead of 200, when you try to use 150 moving average in your in sample and see whether it is working fine, and if it is really working beautifully then 200-day moving average, then you tend to believe 200 is not so good, probably 150 is the good one, so let me start trading live with 150. So this is what you would have done if you have backtested with the larger historical data sets. So for the complete historical data sets for 10 years, if you backtested it and you see that 150 is moving average is good, and then if you go and deploy it live directly, then your results would completely vary. So we are keeping out sample because we consider that this particular sample is not at all tested, and whatever logic we have seen in the historical data sets, if it is showing really good result, how it would have performed in this out sample, the untested data. And then if you go and test it, probably it might not give you the exact results what you have seen in the in sample. So you tend to believe this is not so robust as you have seen in the backtest, because only in those tested periods, probably the market behavior was such a way that it supported 150 moving average. The next 2 years it would have completely moved. So you need to find the optimal balance. So that is why you are segregating between in sample and out sample, to make sure that before you go live, your only expectation or only aim should be try to break your backtesting system, or try to break your overall backtest as much as possible. Because whenever you try to find a fault, you could think where it could go wrong, then before you take it live and you do all these things, you make your system more robust. So before even you take live, you try to break your backtesting system with multiple logics and see whether it would sustain different market phases or not. So that is why we are essentially segregating into in sample and out sample. So let me explain that with an example now. So consider I have taken a simple this 920 short straddle strategy, which is nothing but every day at 9:20 a.m. we are going to short the at the money call option and at the money put option on weekly expiry with a fixed stop loss of 25%. So whenever any specific stop loss is hit, we are going to exit it. Otherwise we'll exit by EOD. So this is the rules of this 925 short straddle strategy. 920 short straddle strategy. Now I have a doubt, which I think that People are saying 25% stop loss is what being widely used. I wanted to test it out. What if in case if I use a 50% stop loss instead of 25? So I used this stock mock platform, which is a no code platform to backtest your trading strategies. I've taken an example from here. So from 2017 to 2018, so I've considered only these 2 years as my in sample data, and I wanted to test out which strategy, whether the 920 short straddle strategy with a 25% stop loss or a 50% stop loss, which one has given me the good results. So that is the logic behind this testing. So my backtesting period is 2017 to 2018. So even though my data is available from 2017 to 21, I have not considered that. Instead, I have considered only 2017 and 18, and I wanted to see whether the 920 short straddle strategy with a 25% stop loss did well or 50% stop loss did well. So I'll just show you what happened. So this is the result. So if you, as you could see now from 2017 to 2018, so S1 is nothing but the short straddle strategy with the 25% stop loss. S2 is the short straddle strategy with 50% stop loss. So as you could see, the one which is having the highest returns is the S2, which has given 1.8 lakhs of profit, whereas the S1, which is 25% stop loss strategy, has given considerably lesser overall profits. So what happens is, when I backtest this and I think, okay, my backtest states that because of these in sample data where I have tested it and it shows 50% stop loss is much better than 25% stop loss, probably I should go with 50% stop loss. So consider you are at 2019 January 1st. So consider this day is 2019 January 1st, which means that prior to that only 2 years of data was available for you. So with that 2 years you have backtested it and you considered, okay, in last 2 years now 50% stop loss really did well. So instead of 25 I should go ahead with 50. So you are starting your year, you are starting your 2019 year and you are trying to go live with this results. So what would have happened if you are going live on 2019? So obviously as long as this 50% stop loss worked fine, you would have got the good results with the same 50% stop loss strategy. But let us check what would have been really well, like what would have happened with 2019 to 2020 or 21. The next 2 years we'll see whether 25% stop loss worked well or 50% stop loss worked well. So I'm going to run the same simulation, same optimizer, and to find out which strategy has done well, whether the 25% stop loss or 50% stop loss in my out sample data, which is in 2019 to 2020. So from initially I have to consider 2017 and 18, which showed me 50% stop loss really did well. So I decided to go for 50% stop loss. But now I wanted to see how this would have performed in 2019 to 2020. So this is the result. So for 2019 to 2020, during the out sample data, I could see 25% stop loss strategy has given higher profits than the 50. So during that period, during the 2019 to 20 period, the complete opposite has happened. So earlier during the in sample data, during 2017 to 18, what you have seen is 50% has really done well. But if I considered, okay, 50% has really done well and went for it, what has happened is that is not the case. That is not the same thing which got replicated. But instead, 25% was doing well in 2019 and 20 during the out sample period. So what we are trying to do is, when you have a specific data and when you're trying to backtest it with complete set of data and you try to go live, you would see there is a drastic difference between your live results and your backtested results, because you're trying to have a specific parameters. You're trying to pick that one up. You are trying to have multiple combinations and see which one has given you the highest profits, and you are going for that because you are trying to fit in your logic into the market noise. So as only when 2017 to 18, those periods, those kind of market behaviors gets replicated in the following years, you would be able to see the same 50% stop loss strategy would work well. But market behavior keeps changing, like the market data keeps changing. Because of that, again 2019 to 20, whatever you have seen in 20 50% stop loss was not working well in the outsample data. So you shouldn't try to have those specific logics where you have to pick up that one single moving average, or pick up that one single parameters in super trend, or pick up that one single stop losses with respect to straddle, and believing that that is the fixed stop loss which is going to work in the coming years. That might not work. So you have to have a balanced logic. So you shouldn't believe that 50% on stop loss is the magical stop loss, because of that I'm earning so much. No, it is not. The market behavior, if it changes, instead of 50, 25% would have worked well. So that is what has happened in the outsample data during 2019 to 20, when we considered the 25% stop loss was working well than the 50. And there is another mistake that people tend to make, is trying to use optimizers or optimization in a wrong way. Say for an example, optimizer tells you like you can have these combinations of strategies or these combinations of stop loss which you can try to deploy it on different days based on your average number of profits. Like say suppose my expectation is to make highest profits, and instead of running a kind of fixed stop loss, like instead of running a 920 short straddle strategy with a 25% stop loss alone, or instead of running the strategy with 50% stop loss alone, I wanted to run it on a different combinations on different days. So I would think that okay, instead of using 50% stop loss on 25% stop loss on Thursdays, if I could use a 50% stop loss which is a bit higher than the usual, then there is a chance that my stop loss might not get hit. So these kind of things that they wanted to implement, like I wanted to use a different stop loss on different days, not only on expiry days. From Monday to Friday, I wanted to find out which days I should apply 25% stop loss and which days I should apply 50% stop loss. So this, if I just run with an optimizer, then that was going to give me the right results. So for an example, if I just run it, okay, find out the best, which of the with the one having a 25% stop loss or with the one having a 50% stop loss is good on Monday, which is good on Tuesday, again which is good on Wednesdays, Thursdays and Fridays. If I just run it, then based on the data, so what I have given is based on 2017 to 18 during this in sample data, I could see that this is how you need to deploy. So the system says that on Monday you run it with 25% stop loss, on Tuesday you run it with 50% stop loss, again on Wednesday you run it with 25%, on Thursday you run it with 50%, and Friday you run it with 25%. So you vary your stop loss with different dates. So Monday you are having one specific stop loss, again on Tuesday you are having different stop loss. This is suggested because of the input data that you have given, which is 2017 to 2018. You have considered these 2 years and you have given the input to the system. The system analyzes those data, market data on those days, and tells you this is the optimal result. This is the optimal allocation that you need to do. So use your stop loss differently on different days to get the highest profits. So when you do that, it shows that you are going to get 2 lakhs of profits with one lot, and also your maximum drawdown is only 7,000 rupees. So you are getting excited and you are telling, okay, instead of me doing all this analysis, the system itself has able to find the best output, and if I deploy this, then I'm going to give you the I'm going to get the highest returns. But what happened is, as I said earlier, so when whatever you're doing it in sample, if the same thing happens in out sample, if the same market data, market behavior, same noise gets replicated, then only you would be able to make similar returns applying the same logic. But when I try to run the same logic, when I asked the systems to find out which is the best combination in 2019 to 20, find out on which days I have to apply 25% stop loss and 50% stop loss, the system said in 2019 to 2020, except Tuesday, you run you run the strategies between Monday to Friday with 25% stop loss. Only on Tuesday you change it to 50% stop loss. So what we have seen in the earlier data 2017 to 18 is completely changed in 2019 to 20. So the system says that with this data, the 2019 to 2020 data, if I run the same logic, then it did not change like earlier. So earlier it kept on changing. Monday on stop loss, Tuesday on stop loss, Wednesday on stop loss, again Thursday 50% stop loss, again Friday 25% stop loss. But in the next 2 years, it suggested that you run it with 25% stop loss throughout the day except Tuesday. On Tuesday you run it with 50%, because the market data again changed. So you can't rely on whatever. So if in case if you have ran this specific optimizer logic throughout the data, instead of putting it in in sample and out sample, if you have run it together, then it would have given you these kind of combinations. And when you are trying to run it with these kind of combinations in live markets, your results would drastically differ. You would be saying, okay, I was having only 10,000 as the maximum drawdown in backtest, but now I'm facing 15,000 as my maximum drawdown. So expert says that you need to stop trading when it reaches 2 times of maximum drawdown. So what would I do? Because you have curve fitted your system, it is not going to work at all in the live markets. So this is the maximum mistakes, or this is the most number of most number of traders do this as a mistake, where they try to curve fit, they try to put in their logic with respect to the market data noise, and they end up getting a beautiful backtest results, but the same thing might not happen in the live markets. So this is what curve fitting is all about. So curve fitting is when a strategy or when a trading edge is not fit to market behavior. Instead, it was fit to market noise. When it fits to market data, it leads to failure in live trading. So when you try to have these kind of higher optimization in your trading strategy, trying to find out okay, which days which kind of stop loss would work, and which days which kind of entry time would work. So when you try to do all these things, okay, some people try to enter a short straddle strategy at 9:20, some people try to enter a short straddle strategy at 11 o'clock in Wednesday, some people do it at 12 o'clock in Tuesday, and again some people say that okay, if I do it after 12 o'clock or 1 o'clock on Thursdays, I end up with higher profits because I have backtested it with different timings and it has given me the optimal or highest results. So when you do these kind of higher optimization, too much of having a different parameters, different stop losses, too much of different entry times, then you are going to get a beautiful best backtest results, but you are going to get absurd live results. It is not going to replicate what you have seen in the backtest, because you have not created a strategy based on market behavior, but instead you have created a trading strategy based on market noise, like whatever happened in the past together. You have tried to fit in your rules and try to find out, okay, this is the optimal thing. If I do this, I'm going to get an outstanding result. So you have to keep it very, very simple. So when you have these kind of multiple parameters from stop losses to entry time, then you end up curve fitting your system. So you might not get the exact live results. So let us conclude this curve fitting with a perfect example. See, what you're seeing in front of you is a normal desert picture. So consider a person like a wildlife explorer, or consider a person like Bear Grylls who travels across the world, who comes to this place to study about wildlife that are living in the deserted place. So now he stays there, he comes here, every day he has his own tent there, and he tries to study all these wildlife animals during his stay. So he almost stayed there for 100 days. Then he thinks that okay, he needs to build his own shelter, which is where he could stay for a little longer and observe the wildlife. So what he thought is, okay, he has stayed here for almost 100 days. In this 100 days, it has not even rained once, because he considered, okay, this is a desert place and it would not rain hardly, and even if it rains, it's not going to be very wild. So he thought, let me build a construction, but somehow I don't need to spend so much of money on a concrete roof. So let me build it with a normal roof structure which cannot withstand the wild weather. But he was there for 100 days and he observed that this is a complete deserted place. Most of the time it is always sunny, it never rains. So after he constructed everything and he continued to watch the wildlife, then one day it started raining heavily, and the next day it continued, and the next day it continued, and it was a drastic rain which almost flooded the complete area. Now the result is, if you look back and see, so the person who came as a wildlife explorer, when he tries to build a construction, his observation period was only the last 100 days. He thought, okay, because nothing has happened in this last 100 days, nothing, no phenomenal higher rain was expecting in those period, he assumed this place is always deserted. So based on that observation, he built a construction. So this is what curve fitting is. So when you try to do it, when you try to have a specific bias towards a specific set of data and try to put in your logic into that market data, then you end up curve fitting your all the complete logic itself. So when you are trying to build a trading strategies, when you're trying to design a trading strategies, when you're trying to backtest it, always keep it simple. The less is more. You don't need to have complex rules. Don't add more and more filters towards it. So just because last few weeks your stop loss was hit back to back, it doesn't mean that you have to go back to your system and tweak it again to adapt to this specific market environment. That is the most repeated mistakes most people do. They once they deploy it live, they see there are some streaks of losses that is happening. They would think that if I have added this specific filter condition, I would have avoided these last back to back 1 weeks of losses. So they go back, tweak it, and again come back, they deploy it live, only to see that market behavior is completely changed. So there could be completely different. Now there is a list of series of gaps downs. What would happen if there is a series of gap up again? And what would happen if there is no gaps at all, if markets stays flat? So these things keeps changing. But if you are trying to tweak your system with every move that is happening in the markets, definitely you are going to break your system. So there is no single systems which can handle all types of markets. That is why people have diversified uncorrelated strategies to reduce their overall drawdowns. But they don't have these uncorrelated strategies to make profits each and every day. They just wanted to reduce the overall risk, overall drawdowns. And second thing is, do not test all your data at once and then go live. Keep it in sample and out sample. Try to test your data with few set of years and try to replicate the same logic in the out sample data. The other set of years, try to validate it and see whether it is working fine or it is broken. So once you do this example, trying to replicate with in sample and out sample, and then you go for it, then it can give you a robust results. Again, there is one more mistake people try to make is, if they see 200 moving average is working fine in sample but not works in out sample, then they go and say what works in out sample, and then they try to go and replicate it in sample. So this is another mistake also people do. So do not confuse too much. Keep it simple. So your idea is to not fine tune your systems with too much of logic. Keep it a lesser relative stop losses. For an example, do not think on each and every day the stop loss, if it varies, then I'm going to make higher profits. No, it doesn't work like that. So you have to find out what the market behavior is. So when you're trying to keep it simple, see, the short straddle strategy is almost like a 920 short straddle strategy is almost like a trend following. So my idea is market trends only few times and other times market stays in range bound. So when it trends big time, if my idea is to cut short my loss in one leg, and if I keep riding the other leg, I end up making profits. So the 920 short straddle strategy is not a market neutral strategy. Instead, it's a trend following strategy. So that is the core logic behind this 920 short straddle strategy. So here I just have to make sure I cut short my loss. So either you can keep it 20%, either you can keep it 25%. If you keep it 5% or if you keep it 6%, like very, very lower stop losses, you could see a beautiful backtest results. But when you deploy it live, it is not going to get the same results, because the slippages could be so high, then you end up losing all your money when you're having a very lower stop losses. So you fit your idea into the market behavior. So the market behavior is like this. When trending thing happens, I wanted to cut short my loss on a losing position in short straddle strategy. So I end up making profits. Now you decide on optimal stop loss and go for it. Instead of that, if you apply it with a different stop losses and different entry timing, then it means that you are too much spending your time on too much of optimization, which is eventually going to go break when you're going to deploy it in live. So this is what you need to keep in mind when you're trying to backtest a specific trading strategy. So thank you. If you have any doubts, if you have any questions, you can just post it in the comment section. I'll address it. Thank you.